Welcome to The Explainer. Today, we're putting on our expert investment analyst hats and putting a massive software giant to the ultimate valuation test. We are going to take Salesforce, the undisputed king of CRM, and evaluate it using the legendary investing frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, before pressure testing the whole thing with modern Wall Street valuation models. So, if you're wondering whether this tech behemoth is actually a value play right now, you are absolutely in the right place.
Here's our roadmap for today. We'll start with a quick Salesforce company snapshot, look through the Warren Buffett, Peter Lynch, and Benjamin Graham lenses, dive into DCF and comparable models, and finally wrap it all up with our synthesis and final verdict.
But before we officially start the gauntlet, I really want you to zero in on this number for a second. $14.4 billion. That is the free cash flow Salesforce generated in fiscal year 2026 alone. Keep that massive cash generation engine in the back of your mind because it's going to completely warp how our gurus view this stock compared to its hypergrowth past.
Section 1, Salesforce Company Snapshot.
Okay, so Salesforce is currently trading right around $195 a share for our models today. They just reported a staggering $41.5 billion in revenue for fiscal 2026, maintaining their absolute dominance with a 20.7% global market share. And this perfectly illustrates their current narrative. They've successfully pivoted from that growth-at-all-costs mindset into a massive, highly efficient profitability engine. I mean, their non-GAAP operating margin has surged to 34%. They aren't just growing revenue anymore. They are literally printing cash.
Section 2, the Warren Buffett lens.
So, how would the Oracle of Omaha actually view this stock? Well, Salesforce easily clears Buffett's qualitative hurdles. That economic moat? It's undeniable. Not only do they have nearly 21% of the entire market, but their remaining performance obligation, which is essentially their contracted future backlog, sits at an incredible $72.4 billion. As for management and capital allocation, they've returned $12.7 billion to shareholders through buybacks in FY26 alone. Return on equity has rebounded nicely to 10.3%, and their debt-to-equity ratio is super manageable at just 0.17. Now, Buffett famously loves a wonderful business at a fair price, and he uses approximate owner earnings to calculate intrinsic value. If we use that $14.4 billion in free cash flow as a proxy for owner earnings, the intrinsic value certainly looks attractive. However, because Buffett demands a really strict 20% margin of safety to protect his downside, he'd probably hold out for a market dip to around $160 a share before he'd comfortably pull the trigger. Section 3, the Peter Lynch lens. Shifting gears to Peter Lynch, he relies heavily on the PEG ratio to evaluate dominant companies, or what he likes to call stalwarts. You basically just take the price-to-earnings ratio and divide it by the expected earnings growth rate to see if that growth is appropriately priced. A PEG under 1.0 is pretty much his holy grail. It signals the stock is undervalued relative to its growth potential. And here's the kicker. Salesforce's current PE ratio is sitting at a remarkably low 0.90. Thanks to their aggressive margin expansion, their forward PE has compressed to roughly 14.9x, all while their earnings growth outpaces that multiple. So for Lynch, finding a balance sheet strong stalwart, and remember, they have over $7 billion in cash and equivalents, with expanding cash generation and a PEG ratio at 0.90, that's a clear and immediate buy signal. He would argue that the market is completely incorrectly pricing this dominant software leader as some mature, stagnant company and totally missing the earnings leverage they've unlocked.
Section 4, the Benjamin Graham lens.
All right, now we submit Salesforce to Benjamin Graham's highly rigid, old-school defensive checklist, relying on his classic asset-based intrinsic value formula. To be thorough here, we're pulling the fiscal year 2025 GAAP diluted EPS of $6.36. And we're using an estimated book value per share of $62.25, which comes from their roughly $59 billion in total equity. Then we plug those into his formula, the square root of 22.5 multiplied by EPS multiplied by the book value per share.
And running that math, Graham's formula spits out an intrinsic value of just $94.38. Compare that to our starting price of roughly $195. Yikes. So the verdict here is a hard avoid or a sell. Because Graham's philosophy relies so heavily on tangible physical assets like think factories and physical inventory, he severely punishes modern asset-light tech stocks. At $195, there is a massive negative margin of safety. Graham just wouldn't touch this unless a market crash sent it tumbling down to around that $75 range. It really just goes to show how historical frameworks sometimes struggle to grasp the economics of modern cloud software.
Section 5, DCF and comparable models.
Leaving those historical gurus behind for a minute, let's build a modern discounted cash flow model based on that massive $14.4 billion in free cash flow we talked about earlier. If we assume a 9% weighted average cost of capital, or WACC, alongside a pretty conservative 3% perpetual terminal growth rate, our base case yields a fair value of $252 per share. And honestly, even our bear case, which assumes a really strict 10% discount rate and only 2% terminal growth, suggests fair value is right at the current $195 price tag. And looking at comparable multiples, you can really see exactly how cheap Salesforce is relative to its enterprise software peers right now. Salesforce trades at a forward PE of just 14.9x. Meanwhile, SAP is sitting at 23.4x, and Microsoft is up at 25x. The software industry average as a whole is roughly 25.9x. If we assume Salesforce simply traded up to that peer average, which is highly justifiable given their margins and their new AI Agentforce monetization, its implied fair value would skyrocket to over $338 a share.
Section 6, Synthesis and Final Verdict.
All right, we've run the hard data through every single framework. Looking at this synthesis, the story becomes crystal clear. Peter Lynch's growth at a reasonable price lens, alongside the modern DCF and comparable models, strongly overpower that outdated Benjamin Graham asset test. And while Buffett might demand a wider margin of safety to hit his absolute ideal entry price of $160, even he would have to recognize the incredibly strong qualitative fundamentals of this business. Ultimately, weighing all the evidence here, our explainer verdict is a solid buy. Yes, for sure, there is the risk of decelerating top-line growth. They're a massive ship. They just can't grow at 30% forever. But the market is heavily mispricing this value growth powerhouse right now because it's still judging Salesforce by its old hypergrowth standards. With their brilliant pivot to profitability, that unmatched $72.4 billion backlog, and an incredible cash generation profile, this is a dominant company trading at a really steep discount to its peers. So as you look at your own investments and evaluate opportunities like Salesforce, which of these frameworks actually makes the most sense to you? Do you demand the deep asset discounts of Graham, the margin of safety of Buffett, the PEG ratio hunt of Lynch, or just the pure cash flow logic of a DCF? Think about it, apply it to your own portfolio, and keep learning. Thanks so much for joining me on this explainer, and I'll see you next time.